The largest margin calls since the COVID pandemic just hit Wall Street, and we're witnessing market crash history repeat itself in terrifying ways. Over $5.4 trillion in equity valuations wiped out in just 2 days as Trump's market crash tariffs triggered a financial tsunami that's still unfolding. What we're seeing in this market crash 2025 has eerie parallels to the market crash of 1929, potentially turning what could have been a correction into something far more devastating. Hedge funds are liquidating positions at a scale not seen in years, and understanding what's happening right now could be the difference between protecting your wealth and watching it evaporate. Market crash history doesn't repeat, but it sure does rhyme. Your time is valuable, so let's get right into it. I'm not here to waste your time, so here's everything I'll cover in this video. What margin calls actually are, and why they're creating a 1929-style selling cascade. The tariff tsunami that triggered this massive market crash today. How hedge funds facing record margin calls are amplifying this market crash explained just like in 1929. The specific sectors getting crushed by forced selling, with tech and export-dependent companies down over 10% in a single day. The critical market crash indicators signaling what comes next, including the VIX spiking above 40. And of course, what you need to know to navigate this market crash 2025 volatility and potentially position yourself for the recovery when $5.4 trillion in lost market value eventually comes surging back. What are margin calls? Before diving deeper, let's understand what margin calls actually are and why they're magnifying this market crash today. When investors buy stocks on margin, they're borrowing money from their broker to purchase more securities than they could afford with cash alone. The stocks themselves serve as collateral for these loans. When stock prices drop significantly, the value of that collateral falls. Brokers then issue margin calls, demanding investors deposit additional funds or securities immediately. If investors can't meet these calls, brokers forcibly sell their positions, often at the worst possible time, to recover the loan amounts. This creates a vicious cycle. Forced selling pushes prices lower, triggering more margin calls across the market, which leads to more forced selling. It's this exact mechanism that turned the initial market crash of 1929 into a catastrophic collapse, and we're seeing the same dangerous pattern unfold in the April 2025 market crash. Let's start by understanding the market crash reason today. On April 2, 2025, President Trump announced sweeping new tariffs that caught markets completely off guard. We're talking about a 10% blanket tariff on all U.S. imports, with even higher rates up to 34% on countries with large trade surpluses like China, the EU, and India. The market crash reason was immediate and brutal. The S&P 500 plunged around 4.8% the very next day, and then when China announced a 34% retaliatory tariff on all U.S. exports on April 4th, markets went into complete freefall. The Dow dropped an astounding 2,231 points, 5.5%, in a single day, creating a market crash Friday that saw the S&P 500 crash nearly 6%, and the tech-heavy Nasdaq plummeted 5.8%, officially entering bear market crash territory. What many don't realize is that these market crash moves weren't just about investors reevaluating companies based on tariff impacts. What we witnessed was a perfect storm of forced selling that dramatically accelerated and amplified the market crash in 2025. And this is exactly what happened in the market crash of 1929, just before the Great Depression. Here's what makes this particularly dangerous. Before April 2nd, markets had been at all-time highs. The S&P 500 had reached around 6,144 in early 2025. Leverage was high, complacency was rampant, and almost nobody was positioned for this kind of shock. That's precisely the environment where margin calls can trigger a cascade of forced selling, leading many experts to warn that a market crash is coming. What exactly is happening with margin calls right now? Reports indicate that hedge funds are facing their largest margin calls since the beginning of the COVID-19 pandemic. This surge is directly attributed to the tariff-fueled market crash today. When President Trump announced those sweeping tariffs, the escalation of the U.S.-China trade war resulted in over $5.4 trillion being wiped off U.S. equity valuations within just 2 days. This sharp and rapid decline in portfolio values prompted major Wall Street banks to demand additional collateral from their hedge fund clients. Multiple prime brokers issued margin calls at a scale not witnessed since March 2020. I've obtained reports showing that ICE Futures US announced updated margin requirements for their gas and power contracts, effective April 11th, with margin calls being issued on April 14th. Similarly, the Hong Kong Securities Clearing Company implemented an intraday margin call on April 17th as a precautionary measure ahead of the Easter holiday market closure. In the technology sector, NVIDIA experienced significant stock price declines on April 16th due to new U.S. export restrictions on AI chips to China, triggering margin calls for investors heavily leveraged in tech stocks. Albemarle, a major lithium producer, dropped 5.9% on April 15th, as trade tensions raised concerns about automotive sector impacts, creating another focal point for margin calls. According to Morgan Stanley's Prime Brokerage report, the Thursday after tariff announcements marked the worst single-day performance for U.S. long-short equity funds since they began tracking this data in 2016, with the average fund down 2.6%. One senior executive at a major U.S. prime brokerage highlighted that the velocity of the moves across asset classes was driving these massive margin calls. This is eerily similar to what amplified the market crash of 1929. Back then, investors could buy stocks with as little as 10% down. When prices began falling, brokers issued margin calls demanding more collateral. Investors who couldn't meet these calls were forced to sell their holdings, driving prices down further and triggering more margin calls in a vicious downward spiral. Lawyer Monthly reported that significant market crash losses had compelled hedge funds to liquidate assets, with major banks requesting additional collateral due to the sharp decrease in their holdings value. Margin calls were observed across various sectors, including technology and consumer goods, raising concerns about continued aggressive sell-offs. In today's crisis, we're seeing net leverage of U.S. long-short equity funds fall to an 18-month low of approximately 42%, reflecting the massive forced deleveraging within the hedge fund industry. Even traditional safe haven assets like market crash gold have experienced downturns as hedge funds sell positions to raise cash to meet their margin obligations. The numbers behind this market crash chart tell a sobering story. Let's look at the hard data of what's happening across different market segments. First, the speed and severity of this decline are unprecedented in recent market crash history. The market crash of 2008 unfolded over 17 months, with the S&P 500 falling about 57% from its peak. In contrast, the April 2025 market crash has already wiped out almost 20% in a matter of days. On April 4th alone, $325 trillion in market value vanished in a single day, more than any single day during the market crash 2008. The VIX, our market's fear gauge, spiked past 40, a level of extreme anxiety typically only seen during major market crash dislocations. Let's break down what's happening with specific sectors. Technology stocks have been hit hardest, with the Nasdaq entering a bear market, down over 22% from its December high. Apple fell 7%, NVIDIA 7%, and Tesla 10% in a single day as investors digested how tariffs would impact their global supply chains and Chinese market access. Global trade-dependent industries are suffering massive losses too. Industrial giants with large China sales like Boeing dropped 9% and Caterpillar fell 6% almost immediately after tariff announcements. Even the energy sector, which typically has its own dynamics, is under pressure as oil prices slide on global demand fears. The entire market ecosystem is feeling the pressure. On April 4th, only 14 stocks in the entire S&P 500 managed to finish higher. That's 97% of major companies declining in a single session. What's particularly concerning is that various market segments that typically provide diversification are all moving downward simultaneously, just as we saw in the market crash of 1929 and again in the market crash of 2008. Not all investors are equally exposed to this margin-driven market crash 2025 selling pressure. Hedge funds with high leverage ratios were the first to face severe margin calls. According to reports, they're offloading most or all of their stock holdings at a pace matching the regional banking crisis in 2023 and the initial market crash during COVID. Retail investors using margin accounts are also feeling the pain, with discount brokers reporting a surge in margin calls to individuals who had become accustomed to using leverage during the 2024 bull market. Certain investment styles are particularly vulnerable to the market crash coming. Growth-oriented strategies using leverage on high-valuation tech stocks, quantitative funds relying on historical correlations that break down in crisis periods, and risk-parity approaches assuming bonds would provide a counterbalance. In contrast, value-oriented investors with low leverage and significant cash reserves are better positioned for this market crash news. Many have been waiting for a pullback to deploy capital. The banking sector faces potential credit losses if the economy weakens and direct exposure to hedge fund clients who may default on margin loans. While banks are better capitalized than in the market crash 2008, regional banks already stressed by prior rate increases are seeing further stock declines. Before making any investment decisions, understand the key risks in this market crash 2025. The most immediate threat is cascading margin calls. If prices fall further, even well-capitalized funds could face requirements they can't meet, forcing more selling in a vicious cycle. Exactly what happened in the market crash of 1929. Political uncertainty remains extremely high. President Trump has shown no signs of backing down, posting that "my policies will not change," despite market crash news today. This hardline stance could prolong market stress. The Federal Reserve faces a policy dilemma unlike the market crash 2008. With inflation still elevated around 2.8%, they can't simply slash rates to cushion the blow. The Fed has warned that tariffs could hurt growth and keep inflation elevated. Global retaliation could escalate, with other trading partners implementing more measures, further disrupting global trade. Meanwhile, corporate earnings estimates for 2025 haven't fully incorporated tariff impacts, potentially triggering another round of selling as companies guide lower in the market crash cycle. Despite the volatility and fear, market crash history shows that dislocations create opportunities for those with capital and courage. Panic selling driven by margin calls often overshoots fundamentals. When investors are forced to liquidate positions, they don't sell what they want to sell, they sell what they can sell. This creates temporary mispricings as seen in previous market crash cycles. Domestic-focused companies with strong balance sheets and minimal reliance on international supply chains could be relatively insulated from tariff impacts. While they'll still feel effects from economic slowdown, they won't face the direct hit that multinational corporations will in this market crash 2025. Companies with pricing power could potentially pass on higher input costs from tariffs to consumers, protecting their margins. If you have cash on the sidelines, averaging in during this volatility could be prudent. Historical data shows that buying when the VX is above 40 during a market crash has generally yielded positive returns over 12-24-month timeframes. Remember that political tensions often lead to market crash overreactions, followed by compromises that ease worst-case scenarios. Successful negotiations between the US and China could spark a significant relief rally, similar to what we've seen after previous market crash events. I've spent countless hours analyzing market crash data from both the 1929 crash and our current situation to bring you this analysis. If you're finding value in understanding these historical parallels and what they mean for today's market crash news, hitting that like button helps the channel grow and lets me know to keep delivering this kind of in-depth research. Your subscription ensures you don't miss critical updates as this market crash 2025 situation continues to evolve.